get you an update on how to trade all of the news flow. Ozan Ozkaral is here. He's the co-founder at Tanto Capital. He joins me live from Mumbai this morning. Ozan, welcome into the program. Good to have you on today. First on Iran, we've had sanctions waivers and Iranian oil now cleared back into the global markets. Obviously, we're seeing some downside pressure for the oil price this morning. Do you think the Hormuz disruption is being priced out of this trade right now? What's happening with oil at the moment?
Good morning, Dan. I think the markets are now pricing the Hormuz situation and the Iran war as a geopolitical risk to monitor, as opposed to something that will cause a global energy shock. And I think that's a positive thing because our world is very much based on having an element of stability when it comes to energy prices. Obviously, the news flow that comes will impact markets going forward, but we seem to have come to a somewhat a compromise situation where oil prices and energy prices are probably likely to remain range bound, although the range is wider than what it was before the war.
Walk me through what you think that range is as well, because Brent is off about a third from its wartime peak now. If the diplomacy track holds, and by most accounts, it seems as if it will, at least through the course of the next week or so, where do you think the price of oil will find a floor?
I mean, again, in this new world that we live in, and when I say the new world, I mean we're not going to have the pre-war normal as a new normal. I think a range between $75 to, say, $90 a barrel is probably realistic. But again, there is still a lot of news to digest, although the intention to settle this is a positive, because no country, doesn't matter if it's the US or China or Europe, can really afford to have a sustained high levels of oil and energy, especially given the existing systemic inflationary pressures that we're all facing there.
Okay, and let's shift gears as well. We're going to talk about, of course, what's happening with Iran, but I wanted to talk about what's happening in the UK in particular. Of course, UK gilt's very much in focus. The big story in the last 24 hours is Keir Starmer's resignation and yields jumping just a little on the politics. For an investor, what does that actually change about how you position around this? And what's your take on what's happening in the UK right now?
Look, there is no easy way to put this, but we can't have a developed market economy that has changed 6 prime ministers in such a short space of time. And given the current macro backdrop where long-term debt is already coming under a lot of pressure, fiscal issues are becoming more prominent than monetary policy issues at large, UK is in a very, very difficult position. My worry about this is that whoever replaces Keir Starmer will not have the luxury of waving a magic wand. And therefore, a lot of tough decisions will have to be made in the country to put it back on track. And I don't really see how that is going to work out in a smooth manner. And I think investors are worried about what may come after Starmer down. So there is no easy way to put this, but UK is on a very difficult path in trying to balance local politics with international competition, at the same time trying to stay ahead of the innovation curve, which frankly is what will really drive future growth in the UK economy.
And I think the question being asked right now is, would a Burnham government necessarily change the fiscal outlook for the UK or be better for markets? What's your take?
I don't think they will change the fiscal outlook. And I don't think they'll be better for the markets because, again, the solution to the problems that UK has right now isn't really a change of leadership within the same party, within the same framework, within the same mindset, but rather whether the leader will have the capacity and the political capital and, by the way, the willingness to instigate serious reform to put UK back into the competitive landscape. And again, time will show, but I doubt that the Burnham government would have such capacity or willingness, although very happy to be proven wrong.
Let's talk about the Fed as well. In your most recent notes, you've been talking about the transition and Kevin Warsh laying out his management terms. What do you think a less hand-holding Fed is going to mean for volatility and for risk assets?
Look, to be honest with you, I see this as a positive because reform at the Fed is not a bad thing. And I think kind of getting the market to focus more on the fundamentals as opposed to trying to price every word that comes out of Fed's mouth when it comes to the forecast of where the rates will be is going to end up becoming positive. But it will take a couple of Fed meetings for the market to normalize and start pricing this new modus operandi. And again, I think globally speaking, we have all come to accept that higher for longer is the new norm, given, again, the inflationary pressures that is systemic, structural. And I think their new approach is going to become better for the markets, better for traders, to allow them to focus on fundamentals rather than the communication coming out of the Fed then.
So, Ozan, what do you think the next Fed move is then? Because obviously markets are also actively repricing the economic impact of the Iran war now.
Look, again, my sense is that given the current macro backdrop, given the inflationary pressures, the Fed's move will probably be to keep the rates where they are for the next few cycles, to monitor the situation. And it's not just geopolitics, it's not just the Iran war, it's also the fact that U.S. markets had been trading quite narrowly with participation rates quite low. A lot of capital concentrated in the hands of few hyper investors that had been frankly hiding behind 7 or so stocks. Now, we are seeing some sort of a rotation coming out of those AI stocks into, more traditional positions, value positions, industrials. So with this current backdrop, I don't think Fed will have a choice but to be, if you will, quite predictable, even though they may not be giving the forecast that they used to. So I would expect Fed to hold rates for the next few cycles.
Okay, holding rates for the next 2 cycles. So, Ozan, the biggest macro theme, at least to your mind, for this year is dispersion. We have the US, Europe, China, India, Japan, all on different trajectories. Where do you put money to work in this environment, and what do you want to avoid right now? What are you telling the family offices you're working with clients that you're working with about where the opportunities are right now?
Yeah. So, look, like you said, the world is becoming increasingly fragmented economically. The United States remains resilient. Europe is struggling for growth. China is wrestling with structural imbalances and really is focused on exports. Japan is continuing to kind of, try to manage the weaker currency. So investors can no longer make one macro bet in the world. And at the moment, there is a higher premium for having some liquidity in money market funds. So the reality is, what my thesis has been lately is that one needs to bet on innovation in the longer term, in the less liquid space, but at the same time can clip something better than what they used to be able to in the shorter duration money market space, with maybe having a bit of an exposure in the higher yielding bond markets, in the shorter dated papers, in potentially certain EM countries, those inflation exporters. And again, this is a time where a dynamically traded portfolio is going to become much more important than having a static portfolio. What I always try to underline, recently at least, is that long-term debt as an asset class is coming under a lot of pressure. So therefore, in a backdrop like this, bet on innovation in the long term. And again, that more or less really means bet on the US markets in the long term. And the short term, have some liquidity to put into use, because the markets will become more volatile. That will bring opportunities. So it's a combination of having some resilience in your portfolio and having the firepower to take or make use of the opportunities that will come about.
Ozan, just before I let you go, do you think we're overdue for an equity pullback in the US, a meaningful equity pullback off the back of what has been strong issuance capital coming into the market through the course of this year, and what is an AI run that just won't quit?
But that's a great question. I think we are due for having a more sensible trading dynamics prevail in the markets, especially the US markets. As I said, to this date, investors had been piling on behind, 7 stocks or so. Now with the new SpaceX IPO, there has been a lot of liquidity that has been taken out of the market. It is natural and, by the way, healthy for the markets to also look at investing in other asset classes that provide a hedge against this current macro backdrop. So do I think that the markets will turn negative? I don't necessarily think so. Do I think that they're going to continue their rally? I don't. When it comes to AI, I think one thing I would like to underline is that so far we have been trading the AI story as if it was only a software story. I think more and more then we're going to find out that AI becomes an infrastructure story, an energy story, so a real physical world story. So there are ways to play the AI trade as well. And it doesn't really mean that you have to go long the 7 stocks. So I think, again, US markets will normalize a little bit, and investors perhaps will take a look at playing the AI game, but in alternative areas and sectors as opposed to just the software side.
Okay, Ozan, we'll leave it there. Appreciate the conversation today. Thanks again for checking in. Ozan Ozkaral there from Tanto Capital. Good to catch up. And up next on the program, South Korea's Kospi seeing a major sell